Hello everyone, welcome to chapter 19. This week's chapter is going to be about risk management and money management. Now, these two topics are the most important ones when it comes to our trading, right? And the thing is that they are quite overlooked and underrated by most traders. And it's my objective with this video right here to explain everything about it so that you have no confusions left. Now, by the end of this video, you'll have a clear understanding of why managing risk isn't just about protecting your capital or preserving your capital, but it's actually more about giving yourself the opportunity or the freedom to grow it up, right? That's what risk management is about. And yes, like always, I'll be breaking down every single topic step by step. I'll first go over their introduction, their specific technique, their purpose, their importance, and then at the end, I'll show you how by applying them, it can improve your trading performance, right? And at the end, we'll also look at different models, risk models for both personal accounts and pro firm accounts, so you'll know how to adjust your risk based on where you're trading. Now, the CRD chapter that I had initially promised is delayed till next week and will be uploaded later, right? So don't worry about it. You are promised that chapter and you'll receive it at the right time. Now, the reason that chapter is delayed is because I wanted to make sure that it's as thorough, as elaborate, and as comprehensive as possible, because I know that there are a lot of misconceptions around candle ranges, and I wanted to make sure that that particular chapter or that particular video clears all of that, right? So that you have no misconceptions, concern, or confusion left about candle ranges or how they work. Now, let's get into today's chapter and let's first talk about why risk management is so important for us as traders. So, first of all, we're going to discuss what is the purpose of risk and money management, or simply why should we care about risk management, right? Now, to simply put it, the purpose of risk management is to prevent us from losing more than we can afford to lose, right? And that makes sure that we stay in the game for longer and we survive trading. We know that trading can be both unpredictable and uncertain, right? And while we cannot control the markets, we can control one thing for sure, and that is the amount of money that we lose on a given trade or a particular single trade. That's the only thing that we can control, and that is what we call risk management, or managing that amount is what we call risk management, right? When you follow good risk management, you're making sure that no single trade or series of trades wipes out your account or blow your account, right? And then this gives you the confidence to keep trading because you know that because of your solid risk management, you are protected, right? Risk management is important to protect your capital, and it also ensures long-term sustainability in your trading. After all, we as a professional traders know that it's not just about making money on a single trade, but it's about consistently managing both your losses and your wins over time, right? So that wins don't make you overconfident and losses don't make you fearful, right? That's what risk management is about. Now, the thing is that you can have the best strategy or the best trading system in the world, but if you're not using the correct risk management, you will lose in the long term and you'll never be profitable and you'll always end up losing your account and blowing your account, right? If you are not using the correct risk management. The key to success in trading is that make sure that you are balancing your risk so that no single loss can heavily impact your overall capital or your emotional state, right? Because losing capital is one thing, but at the same time, those losses are also messing up with your emotional state and your psychology, right? And that can make up things even worse, right? And that can lead you to inconsistent in your approach and can lead you to making irrational, impulsive, and emotional trading decisions, which always end up bad for you and leads to even more losses. And then eventually you end up being stuck in a cycle of losing streak and you'll never be able to get out of it, right? That's what we also refer to as your risk of ruin. And to avoid all of those things, that's where risk management comes in and makes sure that you never fall victim to those things. Now let's move on to the next slide and let's clear up a couple of misconceptions, some common misconceptions that a lot of traders have regarding risk management. Now, first misconception is the idea that having a high win rate automatically means success, right? Now don't get me wrong, like winning trade is great, right? But it's not the full picture or the bigger picture. You could have a high win rate and still end up losing money if you're not managing your risk properly, right? It's really about finding the balance between your win rate and your risk reward ratio, right? So even if your win rate isn't through the roof, you can still be profitable as long as your winners are bigger than your losers, right? And that's only possible when you have a proper and a good and appropriate risk to reward ratio. A high win rate does not guarantee profitability, right? Even traders with low win rate can succeed if they manage risk appropriately and properly, right? Your focus must always be on the balance between win rate and risk reward ratio, and not just the number of wins or winning trades, right? It's not just about how often you win, but how much you win when you do, right? Do you get the difference? Let's say that even if you've got a win rate of, let's say, 40 or even 50%, you can still come out on top if your risk reward ratio is solid, right? Meaning your winning trades are worth at least 2 to 3 times more than your losing trades, right? So if you are focusing purely on win rate, you are literally missing the half picture, right? Half of the picture. It's really about working smarter and not harder, right? It's not about win rate, but it's actually all about the balance between your win rate and your risk reward ratio. And you have to make sure that you are considering and you are taking care of both of them, right? We'll get back to this part later in the video again. Now, the second misconception uh, about risk management is that risking more on each trade will lead to higher gains, right? Now, sure, in the short term, if you are on a winning streak, it might feel good, it might feel like a good idea to ramp up the risk, to increase the risk, and to try to make bigger profits. But the thing is that when that losing streak hits, and trust me, it will hit, and if you're risking too much per trade, your account can spiral out of control really quickly, and you can turn into a losing streak that will not only mess up with your capital and ruin your capital better, it will also ruin and mess up with your emotional state and your trading psychology, right? And both of them are the worst combination that you can have, and you must avoid that emotional state at all cost, and that is only possible if you're following a proper risk management, which not only keeps your risk accountable but also your emotional state and your psychology accountable, right? That's how a proper risk management model works, right? It takes care of about both of your aspects, right? Both your capital and both your emotional state and your psychological state. Another thing is that we know that it's a lot easier to blow your account than to recover from a big drawdown, right? Once your account is down like 20 to 30% or even more, it takes way more effort to climb back up to where you've started to, or to just even reach the break even stage, right? That's what we also call risk of ruin. Recovering from large drawdown isn't just a simple matter of making back what you've lost, right? It's exponentially harder because you are working with a smaller base of capital now, and your mental state and emotional state is also vulnerable and fragile, which can lead to really, really irrational, impulsive, and stupid decision, which makes you lose even more, right? So, while it's tempting to think that I'll just risk more and make it all back faster, that mindset and that way of thinking is a trap, right? The key to surviving in the market long term is consistency. Preserving your capital through solid and steady risk management means that not only you stay in the game, but also you thrive and survive the game even more and actually see those gains over time, right? As a professional trader, you should know and you should have this conscious thought in mind that it's not about hitting home runs every time, right? It's about protecting yourself from striking out, right? And you know that slow and steady always wins the race, right? And you might have heard this saying that trading is a marathon, not a sprint, right? So remember that trading is about all about the long term performance rather than your short term losses or wins. Now, let's move on to the next slide and let's talk about the differences between gamblers and traders, right? Because sometimes people really tend to blur the line between the two, but trust me, they couldn't be more different than each other. So, first up, we've got on the list is risk management, right? Now, gamblers, we know that they're all about taking big risk and impulsive risks, and their whole strategy is just to rely on luck and to hope for things to happen, right? There's no planning there, there's no real planning there. But traders, on the other hand, we know that we are calculating our risk carefully, right? We've got stop losses in place and we're sizing our position properly, right? And we know that it's all about protecting our capital. The goal is to stay in the game long enough so that we can see our success and we can see those gains that we all wanted, right? That's what we trader is think like. Next is the mindset, right? Gamblers are driven by emotions, right? They chase that thrill and excitement of that quick win, right? That rush of adrenaline. But traders, we know that we rely on discipline and logic, right? We stick to a structured system, and even when things get emotional, it's about making smart and calculated decisions, right? And not just reacting to the heat of the moment. Now remember, it all sounds fun and interesting when you hear it or talk about it, but when it comes to live markets and practical application of these things, that's where most of us struggle to apply it in our trading, and we actually doing the opposite and end up losing everything, right? Now the next point is profitability and edge, right? We know that gamblers are relying on luck. There's no real edge or consistency there, and their whole strategy and system is based around hope. They're hoping for the best without any guarantees. But we know that as traders, we're all about probabilities. We know our edge and we make all of our trading decisions and we generate trading ideas based on our system and based on the parameters, criteria, and the rules that we've set, right? And we know that it's not about hoping that the market moves in our favor, but it's rather about knowing the odds and then playing them smartly and not emotionally with our sentiments. The next point is the perspective, right? The perspective is different too. Gamblers are all about short term games and they are living in the moment and they often ignore the long term consequences, right? But traders, we know that we are playing the long game, right? Our focus is on consistent profits over time and we're thinking about the longevity in the markets, right? We're not just here for one good day or one good week. We're here to build something more sustainable that can feed us for the generations to come. And lastly, we've got the risk of ruin, right? Now, we know that gamblers are way more prone to losing everything because their behavior is reckless and outrageous, right? They'll keep doubling down until eventually there's nothing left, right? But traders, we mitigate that risk, right? And we make sure that based on our risk models and on our solid risk management, we make sure that no single trade or loss can wipe out our whole account, right? It's about surviving the bad days and thriving on the good ones, right? So, at first glance, both traders and gamblers might seem familiar, and everyone might relate traders with gamblers. But when you look deeper and actually dig into their thought processes and the way how each one of them conduct themselves in each situations, then you'd notice major differences, right? It's clear that trading is all about strategy and survival, while gambling is just hoping for the best, right? And gamblers use a strategy called the hope strategy where they hope and wait for luck, but we know that luck and hope is not a strategy at all, right? And remember, I'm talking about professional traders here, right? Not your random ass Twitter or beginner traders or your Twitter gurus, right? Again, it sounds relatable, but when it actually comes to live markets, most of you act like gamblers without even realizing it in the first place, right? So don't get too ahead of yourself and being happy that yay, I'm a trader, and you have to actually really dig in deeper and evaluate yourself and see whether you're actually working and behaving and conducting yourself like a real trader, and whether you have those qualities or not, or you're just pretending to be a trader while having all those qualities of a gambler, right? So don't fool yourself. Confront yourself and admit your mistakes, admit those problems, face those problems instead of ignoring them, and only then you'll be able to redeem yourself and improve those mistakes and actually adopt the qualities that a professional trader and that a profitable trader needs and must have. Now, moving on to the next slide. Right here in this slide, you can see that we've got these two equity curves, right? One of them shows the performance of a gambler over time, and the other one shows how the equity curve of a professional, long-term, and a consistent trader appears, right? We've got the x-axis which represent time, and then the y-axis which represent performance, right? Now what you can see in the equity curve of a gambler is that all of their wins and losses are huge, right? When they win big, but at the same time their risk of ruin is also exponentially higher, right? And then when they lose big, and they lose their whole capital in a sequence of just a few losses and a few trades, right? Also, the other thing is that when they lose like 10 to 20% of their capital, which not only messes up with their capital and their balance, but also messes hugely with their emotional state, which lead them to making the worst decision possible, and they stop following their plan and strategy because of it, right? And then they start depending upon hope, and we know that hope is not a strategy, right? Their equity curve literally look like the Himalayan mountains, right? With huge peaks and troughs, right? And it's not consistent at all. You would not see a theme or a pattern in it, right? It would look like someone's having a stroke, literally. And if your equity curve look like this, then just know that you're basically a gambler, right? On the other hand, you can see the equity curve of a professional trader, and you can see that it has a specific theme into it, right? They risk appropriately, and their profits are gained over weeks and months, right? They accumulate those profits over time without any huge wins or home runs, or without any extreme or ridiculous losses, right? You would see that there is a straight upside lope in their equity curve pointing higher and gaining performance and profits over time, right? Like you can see in the curve that it does take time, it takes more time to earn those profits, but the thing is that to those profits they've got sustainability and stability behind it, right? So they are consistent, and they gain those profits over the long term, right? And then they do not lose that at all, right? And they have losing streaks too, like this at times, but they make sure that their capital and emotional state is protected, and they get out of that losing streak, and recover back from that drawdown, right? Without making things worse or falling into a spiral of huge losses or over leveraging their account to try to make everything back, right? They believe and trust their edge in profitability because of the huge sums of data that they've collected regarding their model, and due to that they are aware of the fact that their system can have losses or losing streaks too, and that way they considered it as a part of the game, as or as a normal aspect of our performance, right? And they always keep themselves composed during both wins and losses and losing streaks, right? And always end up making profits in the long run, right? That is the core difference between how gamblers and professional traders perform, and how their equity curve look different from each other, right? Now compare your equity curve with both of them, and if it shows similarity to either one of them, then based on that you can gauge and measure your performance, right? Now let's move on to the next slide, and let's break down a few key terms that are absolutely essential when it comes to risk management, right? These are the building blocks of smart trading, and let's dive into it. So, first up, we've got is win rate, right? This is simply the percentage of trades that end up being profitable out of all the trades that you take, right? So for example, if you win 40 trades out of 100 trades, that gives you a win rate of 40%, right? Sounds pretty straightforward, right? But here's the catch. Having a high win rate does not automatically means you are making money, right? You've also got to look at the win rate in combination with your risk to reward ratio, right? And we'll get into why that balance is so important in a minute. And next up we've got is the risk to reward ratio, or RR, right? And this is all about how much you are risking versus how much you are hoping to gain on each trade, right? And the formula is simple. Risk to reward ratio is equal to the potential reward divided by the amount of risk that you are taking per trade, right? So if you've got a risk to reward ratio of 1 to 3R, that means that you are risking $1 for the chance to make $3, right? And the key here is to make sure that your winners are bigger than your losers, right? Or your winning trades uh, are making more rewards and more profits than your losing trades, right? And even if you don't win every time, due to risk reward ratio, you'll always end up being on top at the end, right? Out of win rate and risk reward ratio, the most important metric is RR, or risk reward ratio, right? Because with a considerate and good risk reward ratio, even if your win rate is low, like 30 to 40%, you'll still be making profit consistently if you stick to your plan and your system with discipline, right? The next metric or key term that we've got is the risk per trade, right? And this is basically the percentage or the amount of your capital that you're willing to lose on a single trade, right? And this is one of the most important factor in protecting your account from big losses, right? If you're risking too much on any given trade, one bad move or one bad loss could wipe out a huge chunk of your capital, right? That's why keeping this risk percentage low and consistent is so crucial and critical, right? And the other thing is that your risk per trade must always stay consistent throughout your trading journey, right? It shouldn't change because of your performance or your wins and losses, right? Now the most reoccurring theme among losing traders is that they change their trade per risk or risk per trade based on their performance, right? For example, if they go into drawdown or a losing streak, what they do is they increase their risk per trades and the hopes of recovering everything back, right? Recovering what they lost. But instead, what ends up doing and what's end up happening is that they lose even more, right? Similarly, when those unprofitable traders go into profits, they become overconfident and euphoria get a hold of them, and due to that they start increasing their risk in the hopes and the dreams of making it big. But instead what happens is just a single loss increase their risk of ruin so much that they lose everything on a single trade and ruins and messes up with their months and months of profits and growth and performance, right? That is why it is so important that your risk per trade stays constant, and it shouldn't be influenced by your trading performance or your profit and loss ratio, right? It must be treated as a constant quantity or a constant entity. And finally, we've got position sizing, right? And uh, I'm sure that most of you already know about it. This is basically the process of figuring out how many units, whether that's shares, lots, or contracts, you should be trading, right? If you're trading forex, then most of you would calculate your position size and lots, right? You can either do it automatically with an EA or something, or you could do it manually with a position size calculator, right? You'll just have to put in the risk that you want to take in dollars and how much is your stop loss size in pips, right? Similarly, if you're trading indices, then you're going to be calculating your position size and contracts, right? It could be micro contract, mini contracts, or macro contracts, right? And depending upon how much you're willing to lose on a single trade, and depending upon how much your stop loss size is, right? And that would be determined and measured in handles or points and so on, right? And position sizing isn't just about throwing out random numbers, right? It's based on your account size, your risk tolerance, and what is your stop loss size or your stop loss range in pips or handles or points, right? And proper positioning sizing ensures that you're not risking more than you should, and it basically ties up everything that we've so far talked about, right? It ties up win rate, RR, and the risk per trade together. Moving on to the next slide, right here you can see that we've got this table right here. This table shows the relationship between win rate and risk reward ratio, right? This is like a really insightful and informative table because it really digs in deeper to how win rate and RRR are interconnected with each other and how each metric and factor affects our performance as a whole. You can see a lot of variables and colors in this table right here. And in this slide, I'll explain each factor to you. And at the end of this slide, I guarantee you that your whole idea and perspective about trading will be completely changed, and you will start looking at things differently, right? Now, oftentimes people ask me about Enigma, telling me what Enigma is, and they think that Enigma is hidden in the charts, but they are absolutely wrong, right? You must have also heard ICT saying that Enigma isn't in the charts, but it's actually an external factor. And in this slide, I'll explain exactly what he meant by this, right? And what does that mean, right? This chart right here, this table is the closest thing to Enigma, right? And the reason why I'm claiming that is because we all know that we are here to trade. We're all here to trade for one specific purpose, right? Every one of us has the same purpose for trading. We're not here to have fun. We're not here to help anyone, right? We're not here to do anything else. The only sole reason and the sole purpose we are here to trade is to make money, right? That's what trading is all about. Now, that being said, we know that at the end of the day, we're doing all of this just to make money, right? Not to just make money, but instead to make money consistently over a period of time, right? That's what the purpose is. Now, as professional traders know that if we focus on the money aspect alone, it will lead us to losses, right? And that's the wrong way to approach trading. But instead, the correct and accurate path is to focus on following your plan and system consistently, and make sure that you're consistently trading your system with a solid risk management and solid discipline, right? Now, one of the main aspect of that whole process in your trading system is risk management, right? And it's just as important as your technical system, right? Or some could even say that it's slightly more important than your technicals, right? If you have a correct perspective of risk management, and if you approach it differently and more accurately than most people, then you'd have a really huge edge over the markets, right? And your whole perspective will be changed. Now, the way how you change your perspective about risk management is by looking at this chart right here that you are looking at, right? From here, you can see that on the x-axis, we've got these different win rates, right? Starting off with a 10% win rate and then continuing that till the 90% win rate, right? And on the y-axis, here we've got the different RRR, starting off with the 2 to 1 RR risk reward ratio, which means that you are risking $2 for only $1, right? Which is basically negative risk reward ratio, right? And that's actually worse than gambling, right? Then we've got the 1 to 1 risk reward ratio, which means that we are risking $1 to make $1, right? We're risking 1 for 1, which is also a fairly poor risk reward ratio, right? Which you shouldn't be using, right? Then moving on to 1 to 2 risk reward ratio, which means that we are risking $1 for a reward of $2, right? Which is a good risk reward ratio and a fair one. Next up is 1 to 3 RR, which is the most optimal risk reward ratio, which means that we are risking $1 to make $3, right? Now, down below, you can see the red rectangles, which represents the non-profitable scenarios, or scenarios in which you will be at loss for a particular set of data. And then we've got the yellow rectangles, which represent the break-even scenarios. And then last but not least, we've got the green rectangles representing the profitable scenarios, right? And the profitable cases. Now, your objective is to see these profitable scenarios and look for profitable combination that lies in the green area or the profitable area. Now, let's discuss some big combinations in the table to explain the relationship between win rate and risk reward ratio, and to prove to you how risk reward ratio is important as, or even more important than win rate, right? And win rate on its own does not make that big of a difference, right? It's actually risk reward ratio and its relationship with win rate that actually changes up everything in our trading and make sure that we are consistently making profits in the long run. So first up we've got is the 2 to 1 risk to reward ratio, which as I said before is like a really poor risk to reward ratio, right? It means that your rewards are half of what you are risking, right? And that's the worst case that you can have for your risk to reward ratio. It does not get any worse than this, right? Now, what this proves right here is that if your whole focus was just on win rate alone and you really did not care about risk to reward ratio, then here, even if you had 60% win rate, which is like an optimal win rate, even with that, you would not be profitable and you'll end up losing money for a particular set of data, right? For this sort of risk to reward ratio, you'd need a minimum of at least 70% win rate to be profitable, right? And if it's lesser than that, then you would not be profitable. Next up we've got is the combination for 1 to 1 risk to reward ratio, and let's see the different combinations for it. Right here you can see that with 1 to 1 risk to reward ratio, if your win rate is 10%, it's pretty self-evident then you would lose, which, right, is pretty obvious. If you have a win rate of 20%, again you would not be profitable, again pretty self-evident and obvious. Similarly, if you even have a win rate of 30% or 50%, you'd still not be profitable and you won't have any progress in the long term, right? Now, right here, you can see that the only scenario for you being profitable is if you have a win rate of 50%, right? And only then you'd be able to be at break even stage, right? Not even profitable, but just barely at break even, right? Meaning your losses and wins will be the same and you'd neither be profitable not at the losing curve of your performance, right? This shows that even if you win 50 trades out of 100 trades, you still you still not you still wouldn't be profitable, but instead you still would have made no progress at all. And remember that 50% win rate is considered like a good win rate, right? And even with that, you would still not be profitable because of your poor risk to reward ratio, and you would need at least a win rate of 60% to be profitable with the 1 to 1 risk to reward ratio. Next up we've got is the different possible combinations for 1 to 2 risk to reward ratio. Now this risk to reward ratio is considered a good and average risk to reward ratio, right? And this is like the minimum that you should be aiming for as a trader. If it's lower than that, then you must never trade or approach it, right? The minimum RR that you must be seeking and aiming for should be at least 1 to 2 risk to reward ratio, right? Before you could trade a particular trade idea or execute it. For a 1 to 2 risk to reward ratio, you can see that you only need at least a minimum of 40% win rate to be profitable, right? Which is like a good number. That means that you only need to win 40 trades out of 100 trades to be profitable, right? From this you can see that even when you have more losses than wins, you are still profitable because you are winning more on your winning trades than you are losing on your losing trades, right? You're risking $1 to make $2, right? If you lose a trade, you are losing $1, but if you are winning a trade, you are winning $2. So let's say you had 10 trades, right? And you had a win rate of 40%, right? And you won 4 trades and lost 6 trades, right? Because you had a 40% win rate. So that means on the losing trades you lost $6, but on the winning trades that you had, which were 4 winning trades, you won $8, right? Because 4 trades and each profited $2, and 4 multiplied by 2 is equal to 8. Now subtract the losing amount from the winning trades and you'd end up with your profit and loss ratio. And if we subtract 6 from 8, it's equal to 2. That means that with that framework and scenario, you'd end up with $2 profits or 2 hour profits, right? And from this you can see that even when I lost, or even when you lost more trades than you win, you still were profitable and you still end up making profits because you won more on your winning trades than you lost on your losing trades. That is the power of RRR, or risk to reward ratio. Next up we've got is the 1 to 3 risk to reward ratio, which is basically my bread and butter and basically my go-to RR, right? This is my optimal RR, and I always look for trades that at least offer me a minimum of 3R, right? If it's lower than this, I won't be taking or executing that trade, right? This is like basically this is basically a set rule that I've set for myself, which is that I need at least a minimum of 3 risk to reward ratio before I could execute a trade idea. Now the reason I've chosen this risk to reward ratio is my optimal RR for my trades is in another story in itself, but the main thought process is right here explained in this table. You can see that for a 1 to 3 risk to reward ratio, you only need at least 30% win rate to be profitable, right? Now that from this information, you can see that it's really exponential, right? It means that if I have a 1 to 3 risk to reward ratio, even if I take 100 trades, right, and I lose 70 trades out of those 100 trades, I'll still be profitable at the end of that set of data, and at the end of that 100 trades, right? I would have to only win 30 trades out of 100 trades to be profitable, right? And you can see it's really surprising and really great, right? That's how powerful and strong risk to reward ratio is, right? That is the power of risk to reward ratio, right? Even with a win rate like 30%, which is considered like an awful win rate, you will be still profitable if you follow your plan consistently, and with every trade that you win, you are winning 3R, right? You're winning 3 times more than what you've risked. And now imagine you have this risk to reward ratio and you are trading with a complete system such as ICT and CRT or candle ranges, and you have a win rate of 60 to 70% or a win rate of 80% like me. And imagine your performance in those cases, right? And you can see this is where the real enigma lies in, right? People look for it in the charts, but it's actually in the relationship between win rate and risk to reward ratio, right? What this also shows you is that you don't have to crack enigma or find the holy grail of the charts, right? You only need a mechanical and objective simple system or a strategy with a decent 1 3 raised to 1 ratio and win rate. You don't even need like a win rate of 60%. You can only have a win rate of even just 30%, and you'll be still profitable if you stick to that system, consistently follow it with discipline, and you have an average risk to reward ratio of 3R, right? That is the power of the relationship between win rate and risk to reward ratio, and that is one of the main aspects of our risk management plan. Now, after watching this part of videos, some of you might even claim that a risk to reward ratio is more important than win rate, and in some cases that's true, right? Now, that being said, you can also see the different combinations for higher risk reward ratios below, and how much win rate you need minimum to be profitable, right? You can examine and analyze these combinations yourself. Now, you can have these higher RRs too, but they become really stressful in the sense that the more RR you have, the lower your win rate is going to be, and it takes a lot of accuracy and precision to have a higher risk reward ratio than 1 to 3R, right? That's why I've chosen 1 to 3R. Now, for me, I can also have an average of 1 to 4 or even 1 to 6 risk reward ratio, but then there are too many other factors and variables involved, which I want to avoid. That's why 3R is my sweet spot where I find myself comfortable in. Now, you shouldn't choose a 3R as your risk reward ratio just because of me or just because of someone else, but instead, you need to find your own system with your own average risk reward ratio, and you need to try out multiple combinations and see which one suits your style and your mental capabilities and your trading psychology the best, right? Now let's move on to the next slide and let's discuss and let's talk about something super important that does not always get the attention it deserves, but it really is one of the most essential and crucial part of our risk management and trading as a whole. This is one of those concepts that every trader needs to understand and be aware of, because first of all it's about survival in the markets, and only then you will be able to thrive. This is the concept of risk of ruin. So what exactly is risk of ruin? Basically, it refers to the probability or the chances of you blowing up your account to the point where it's almost impossible to recover from. And let me tell you, poor risk management, over leveraging, or taking on too much risk per trade can skyrocket your chances of hitting that ruin point. And once you are there, it's an extremely difficult battle just to get back to where you started, and let alone making profits, right? That's what risk of ruin tells you about. Now let's look at the difference between personal accounts and platform accounts when it comes to risk of ruin. On a personal account, you have a bit more flexibility because there's no set drawdown limits or any maximum drawdown limits imposed by anyone, right? But that also doesn't mean that you can be reckless and outrageous, right? Because you know that after all, it's your own money on the line, and you still have to make sure that you hold yourself accountable and follow your plan consistently with discipline. You still need to prioritize capital preservation and think about the long term, right? And keeping your account alive should be your top priority at all times. On the other hand, prop firm has a lot stricter rules, right? Like maximum drawdown limits. And these rules are there to first of all to protect the firm's capital and to make sure that you are not gambling and you're actually trading consistently with a proper plan and a proper system, right? But that also means that you've got to be a lot more conservative with your risk, right? Because if you're risking too much on a single trade and if you hit that drawdown limit, you're out. So the approach for a prop firm has to be different, and you cannot treat it like a personal account because the stakes of blowing up your account are a lot higher, and the room for error is smaller because how small of a drawdown limit that they have set, which is like only 10% for most prop firms. Now, let's dive into why you want to avoid the risk of ruin and how the math makes it pretty clear that substantial losses or exponential losses are something that you should be really seriously cautious about. First off, when you take a hit in your account, it's not just about making what you lost in a one on one ratio, right? But instead, it becomes a lot harder and difficult because the bigger the losses, the harder it is to recover. And let me break it down for you. If you lose 10% of account, you need to make an 11% gain or profit just to get back to where you started, right? It sounds a bit tricky, right? For example, let's say that you lose 50% of the account. At that point, you don't just need a 50% gain to recover to where you started from, right? You actually need to make a full 100% gain because you are now working with a smaller base, which means that every percentage gain has a less impact. And if you are down 70%, 75% from your initial balance, now you are in a serious trouble because you need to now make at least 400% return just to get back to where you started, because the base capital that now you are working with is smaller, right? And imagine the pressure of trying to hit 40% gain after already losing most of your capital, right? And it's almost like trying to climb a mountain with a huge weight on your back, right? It's not impossible, but it's definitely not where you want to be as a trader, right? That is why protecting your capital is so important, right? Small losses are manageable, but once those losses start to snowball, they become exponentially harder to recover from, right? And that's where risk management comes in. The goal is to prevent your account from ever reaching a point where recovery feels out of reach, right? And by keeping your risk per trade low, staying disciplined with your strategy, and avoiding over leveraging, you can avoid digging yourself into that hole where it's nearly impossible to climb out of. So in short, avoid those huge losses at all cost, right? The smaller your drawdown, the easier it is to bounce back and stay in the game. In trading, we know that survival is the key, right? If you can protect your capital and limit your drawdowns, you give yourself the best shot at the long-term success, right? And trust me, it's always better to take small, manageable losses than to put yourself in a position where you're chasing massive gains just to recover from a big loss that you've had. Now, moving on to the next slide. Right here in this slide, we're going to look at the risk of rune table, and it's going to explain what risk of rune actually is, how does it work, and why you should be aware of it. And then in the next slide, we will discuss its importance and benefits. So basically, the first thing that you need to know and be aware of is that risk of rune is calculated based on your risk per trade, your maximum drawdown, your win rate, and most importantly, your risk to reward ratio, right? These four are the main requirements and metrics required to calculate your risk of rune, right? You're gonna perform weekly and monthly reviews and collect as much data as you can, and then based on that data from your model, you'll calculate your risk of rune, right? Now it's pretty simple to calculate. You just have to go to a risk of rune calculator website and put in these values from your model, right? And then you'll get a percentage value, right? I'll also explain a few combination here as well so that you have an idea about it. So for the risk of rune table, our risk per trade right here is going to be a constant of 0.5% risk per trade, and our maximum drawdown here is 10%, which is basically like the maximum drawdown limit for most platforms, right? So basically you can say that this risk of rune table will explain the risk of rune for your funded account. Now right here, first of all, you can see the different win rate, right? We've got 20% win rate all the way down to 50% win rate. And then along with it, we've got the different combinations of those win rates with these different risk to reward ratio. We've got the 1 to 1, the 1 to 2, and last but not least, the 1 to 3 risk to reward ratio and their combination with win rates. Now you can see that if you have a 10% maximum drawdown and your risk per trade is 0.5%, then based off of those factors and metrics, it would take you at least a losing streak of 20 trades before you could blow your account. Or the other scenario is if you are on losing performance and your win rate and RR combination is in the losing curve and your equity is going down, that's the case where you're also going to end up blowing your account and reaching the 10% maximum drawdown. For example, with a 20% win rate and 1 to 1 risk to 1 ratio, the chances of 20 consecutive losses are 6.73%, which you can see are pretty low, but that's not the important metric, right? The important metric right here is that your risk of rune percentage. Now right here you cannot see the risk of rune percentage, but it's showing you in terms of how much is that risk of rune, right? I'll also give you a percentage value for that as well. So in this case, your risk of ruin is extremely high. It's really high right here, right? You can see the risk of ruin or simply your risk or chances or probability of you blowing your account is higher than 90% in this case, right? This is what this data show and this is where your eye should be. With a system that has a 20% win rate and has a 1 to 1 risk to reward ratio and you are risking 0.5% per trade with a 10% maximum drawdown limit, your risk of ruin is higher than 90%, which is extremely high, which means that you have a higher than 90% chances of you blowing your account and you will never be profitable with this sort of system, right? Similarly, even if you have a win rate of 20% with the 1 to 2 risk to 1 ratio and risking 0.5 per trade with the same 10% maximum drawdown, then still your risk of ruin is high, right? And by high, it represents a value higher than 85%, right? Meaning your risk of blowing your account and depleting everything is higher than 85%, again 85%. And again, you can see that it's pretty self-evident that you won't ever be profitable with it because your chances of blowing up your account are higher than 80%, which is like extremely ridiculous and ridiculously high. Similarly, if you have a win rate of 30% with a 1 to 1 risk to 1 ratio with the same risk parameters, then your risk of ruin is again high, meaning it's higher than 85%, right? Which again, as you can see, is extremely risky and high, and you will never be profitable with such a system. If you have a win rate of 30% but with a 1 to 2 risk reward ratio with the same risk parameters, then your risk of ruin is moderate, right? It's showing moderate, but it's still high, and it's or a moderate term suggests a percentage value of higher than 70%, meaning your risk of blowing everything up and losing everything while risking only 0.5% per trade is 70%, right? Remember, in all of these scenarios in combination, you're risking only 0.5%, and still your risk of ruining your account or blowing up your account is that high, right? You're not even risking bigger than that, right? This data only takes and considers the trades where your risk is only 0.5%, and still you can see that your risk of ruin for those win rate and risk to reward ratio combinations are higher than 70 and 90%, because you can see that the edge is pretty low in those cases. But right here you see that if your win rate is 30% and you have a 1 to 3 risk reward ratio, then in that case your risk of ruin is lower, right? It's lower than 50%, and this is where you should be aiming for. If your risk of ruin lies in the moderate, the high, or the very high region, right, which means that it's higher than 50%, then you are at risk of blowing everything and you'll lose in the long run even with a 0.5% risk per trade, right? That's why you must always make sure that you adopt a strategy where the combination of the win rate and the risk reward ratio offers you a risk of ruin percentage of at least lower or lower than 50%, right? Or at the low section, only then you'll be able to win in the long run. Similarly, if your win rate is 40% and your risk reward ratio is 1 to 3R, then in that case your risk for ruin is very low, meaning it's lower than 30%, which is extremely low. And for that particular scenario, you can see that if your risk of ruin is low and it's lower than 30%, then that means that you have a lower than 30% chance of blowing up your account, which is extremely highly unlikely, right? And these are the type of values, and these are the type of risk of ruins percentage values that you must be aiming for. If your win rate is 50% and risk reward ratio is 1 to 3R, then in that case your risk of ruin is none to zero, meaning your chance of blowing your account or reaching the 10% drawdown is zero, and you will never reach that drawdown as long as you consistently follow your plan, which has a 50% win rate and a risk reward ratio of 1 to 3R. And this table right here, by blowing account, I mean reaching 10% drawdowns, right? So remember that. And you can see the rest of the combinations for yourself, and you can examine the whole table. Now, let's move on to the next slide and let's discuss why it is so important to be aware of your risk of ruin percentage value for your respective system or model, and exactly how does it help you in your trading, and exactly which aspects does it help with. So we've got these aspects down the list, and we're going to discuss each one of them separately one by one. First of all, let's talk about capital preservation or capital protection, right? Now, understanding the risk of ruin is like a huge deal when it comes to protecting your account, right? Because essentially, knowing your risk of ruin is like having a safety net. It helps ensure that you do not drain your entire trading account because of a few bad trading decisions or because of a few losses, right? That's the whole idea of risk of ruin is. The whole idea is to make sure that you are in this game for the long run, right? And for the long term. And as a trader, your main priority and your number one priority should always be to protect and safeguard your capital. The next aspect that risk of ruin helps us with is our psychology, right? Psychological preparedness is what it helps with it, right? Because being aware of the risk of ruin doesn't just helps you avoid losing all of your money, it also helps you get your mind right. It also helps you get into the right uh, mindset, right? When you know that there is always the chance of losses, you are more mentally prepared to handle them when they come, right? It helps you stay cool during drawdowns or during losing streaks, right? And make sure that your emotions are always in check, and that eventually leads you to being disciplined in your approach rather than making impulsive and irrational trading decisions in the heat of the moment, right? That's what risk of ruin helps you with. It makes you psychologically more prepared and more stronger and more improved. Another aspect is another aspect that risk of ruin helps us with is performance measurement, right? Now, performance measurement is another key part of it, right? By monitoring your risk of ruin, you're actually keeping track of how well your trading system is performing or how bad it is performing. If you're seeing that you're constantly bumping up against the risk of ruin and your risk of ruin is increasing, it might be a sign and a signal for you that something in your approach needs adjusting, right? And this is how exactly you refine your strategy and make adjustments in it, and that will eventually lead you to enhance and improve your overall performance over time, right? And then last but not least, we've got accountability, right? Risk of ruins and being aware of the fact that there is always a chance of you blowing up your account, which is basically known as risk of ruin. That idea and that thought process and that conscious idea makes you more accountable, right? Because recognizing the risk of ruins instills a sense of responsibility in us as traders, right? It's a constant reminder for us to stick to our risk management rules and not get reckless, right? When you are aware of these risks, you are more likely to think before taking trades or before generating any trading ideas, right? That don't fit your plan, right? And it instills a sense of accountability and responsibility in you, right? And it makes sure that you avoid making those reckless decisions that eventually or that can lead you to disaster, right? Or that can lead you to enter a spiral of losses and losing streaks that eventually ends up with your account being blown. So, in short, understanding the risk of ruin is not just about avoiding losses, it's about being mentally prepared, constantly evaluating your performance, and staying accountable to your own trading rules, right? It's what keeps us on track and in the game for the long term. Now, let's move on to the next slide and let's now discuss drawdowns. Let's first of all break down what we mean when we talk about drawdown. So basically, a drawdown is basically the decline in your account's equity from its highest point down to its lowest point before it starts recovering and hits a new peak, right? So it's the dip in your account balance when trades don't go your way or you end up in a losing streak or a series of losses, right? That's what drawdown is. Now there's a couple different types of drawdowns we need to pay attention to. First up is the maximum drawdown, right? This basically gives you a measurement of the biggest drop you've ever had in your trading performance over a set record of data from a peak to a trough over a certain period, right? It's super useful for understanding the worst case scenario for how much you could potentially lose during a rough patch. It basically shows you what is the biggest losing streak that you've had, and that gives you an idea about the fact about the fact that these sort of big losing streaks exist too in your trading system, even when you follow your plan consistently and even when you stick to your plan perfectly, you still can incur and have these losing streak and these big losing streaks which can lead you to being in drawdown. And when you are aware of this fact, it makes you psychologically more prepared, and instead of you be panicking in that situation, you then become more informed and more disciplined because you know that this is just a part of the game, this is just a part of the process, right? And instead of being irrational and starting to make impulsive and irrational decisions about it, you're going to approach it more appropriately and in a professional manner and conduct yourself better, and that way you'd be able to survive through those drawdowns and eventually recover from it and then make profits, right? That's what the idea of maximum drawdown is. And then we've got average drawdowns, right, which looks at the average decline from peaks to troughs over a set time frame, right. Peak is basically the highest point, or trough is the lowest point, or basically your winning streak or losing streak, right. It helps give you a sense of what your typical losing streak look like, right. You It's inevitable. We as a traders know, and we believe in the idea, I believe in this fact, that losses are inevitable. You can never have 100% win rate system or strategy that never loses, right. Every single system that there exists must always have losses, right. And with losses, there's also the variable of losing streaks involves too. So because if losses exist, then losing streaks exist too, right. So for your system and model, you're going to perform your weekly performance reviews and collect as much data as you can about it, and then you're going to see what are the typical losing streak for your model look like. For some of you, it might be an average of three trades worth of losing streak. For some of you, it might be an average of five trades worth of losing streaks. And when you see and you check and analyze your data for a long time, for years of data, and you see that maybe every single month or every single quarter you have these potential and these inevitable losing streaks in between, right. And you're aware of it, and when you've seen this, then you're going to be more appropriate and more professional about it when they occur, because you know that they are pretty normal. It's an average drawdown for me, and I don't have to panic about it. I have to act professionally, and the only way I'm going to recover from these drawdown is by following my system without being fearful about it, or without hesitating to execute my trades because I am in a losing streak. And in that way, and in those scenarios, what you'd also make sure is that you don't increase or decrease your risk, right, because you are performing badly or in a good manner, right. Because if you decrease your risk, or maybe you increase your risk in the hopes of recovering back from that drawdown, maybe you lose that trade again, and then you eventually end up going near toward your risk of ruin, and your risk of ruin, and that probability of you blowing your account increases, which could also mess up badly with your with your trading psychology and your emotional state as well. And that is the worst combination that you can have as a trader. Now, if you've asked me why these drawdowns are so important, then I've already explained it to you. But to basically sum it up, or to bring it down to just a few points, the first one is for risk assessment, right? Knowing your maximum drawdown helps you gauge and measure how much risk you are exposed to, and it gives you a benchmark for setting your risk limits, right? And second, there is the psychological impact, right? Drawdown can mess up with your mind if you're not prepared, and if you're a novice trader, and it can lead you to impulsive and irrational trading decisions. But if you are prepared, and if you've actually analyzed and checked your model's data, then you'd be more prepared for it, and you wouldn't panic at all, right. Knowing what your typical and worst case scenario for drawdowns look like, knowing that helps you mentally prepare for those dips and those drawdowns, so you can keep your cool when your account takes a hit. That's the importance of drawdown, or being aware of your drawdown for your respective model or system. All right. Now let's move on to the next slide, and let's see what we've got. So now that we've covered all of the foundational concepts around risk management and drawdowns, it's time to dive into something really more practical and important, which is risk management models, right? Now these models are built on everything that we've discussed so far, right? It takes everything that we've discussed: your win rate, your risk to reward ratio, the drawdowns, and the importance of capital preservation, right? And now the goal here is to for me to give you a practical framework that you can apply to your trading system or your trading strategy. And whether you're working with a personal account or a platform, that won't matter. It's a dynamic, and it's a strategy that is applicable for both of the accounts, right. And first of all, let's remember principles that we've talked about so far, like the importance of managing your risk per trade, understanding your risk of ruin, knowing and being aware of those fundamental concepts is essential to understand how these models work, right? Each one of these risk management frameworks will help you measure how much risk you are comfortable taking on, and it will also allow you to making much more informed decisions based on your trading style and goals. Now what I've done here is I've created a few different models that caters to various risk tolerance, ranging from aggressive to conservative approaches, and this way no matter where you fall on that spectrum, there is always something for you, right? Whether you prefer to push it hard a bit more or you want to play it safe, these models will help you structure your trades in a way and in a manner, in a fashion that minimizes the chance of hitting that risk of ruin while still aiming for profitability and profits. So moving on, right here we've got an example of this case study or this conservative and the realistic trading model. You can adjust the metrics based on your own data, but this one right here we've got here is to just to explain how RS model works. So this model has got a conservative and respective win rate of 40%, right? And you know that that's a pretty achievable and feasible win rate in my opinion, right? It's not that hard to achieve a 40% win rate. A 40% win rate basically means that out of 100 trades, you only have to win 40 trades. And if you're using the correct way to trade candle ranges, and if you know what you're doing, and if you are in CPI, right, and if you watched my trade breakdowns, and if you watched my contents, and if you are about to watch even more of my content, and you are diligently studying it, and you are following them religiously, making notes, backtesting them, then I can assure you that forget about 40% win rate, you can even achieve 80% win rate or even 70% win rate, right? So that's not going to be a problem for you, right? Moving on to this new level 5 and level 6, I will take your trading knowledge and your technical knowledge about candle range in the CRT and IC to a next level, right? And then at that level, even a win rate of 40% would look like mediocre to you, right? Because of the amount of knowledge and the type of knowledge that you will have. The amount of knowledge does not matter, right? The amount of knowledge does not matter. You can have all of the knowledge in the world, but if the knowledge isn't right, it's not going to serve you any purpose. But if you only have just limited amount of knowledge about a particular thing and you master it and you reach the peak mastery of it and learn it from someone that has actually done it and that is actually using it to make money consistently, right, for years, then that's what matters to me and that's what should matter to you, right? So here we've got a 40% win rate, and believe me, a 40% win rate is pretty easily achievable and feasible if you are using my approaches in the correct way to trade candle ranges, or if you have a strategy similar to mine, right? And next up we've got is the risk to reward ratio, which for this model has an average of 3 RR or 3 risk to reward ratio, which again is feasible, but also remember this isn't the only limited option you can have, right? You can have a 2 RR for as well, or you can have a 4 risk to reward ratio too, right? I've set this 3R here just to explain this case study. The next metric that we're going to consider is the trades per week, which these models offer around 3 to 4 times per week, right? 3 trades per week, 3 trades per week is the average trade quantity that this model offer. And next up we've got the important metric, which is the risk per trade, right? And for this model, the risk per trade would be 0.5%, right? And as we are discussing this for mostly prop firms, the maximum drawdown limit is going to be 10%, right? Now based on these metrics and parameters, the risk of ruin for this model, basically meaning the chances or the probability of this model to blow the account by reaching the 10% maximum drawdown is extremely low, right? It's about 3.62% which is basically next to zero, right? Which means that if you have a similar model to this, where your win rate is at least 40% and have an average risk reward ratio of 3R, and your risk per trade is constant of 0.5%, then there is only a 3.62% chance of you blowing your account or reaching the 10% maximum drawdown, which means your chances of blowing are really slim and next to none, which also alludes to the fact that even this conservative and realistic model with these metrics and parameters is good for prop firms, right? Now this isn't like a 80% win rate or a 10 average risk to reward ratio model, but instead it's pretty attainable and feasible, like 40% win rate and only 3 RR, right? And it ain't that hard. And if you're capable enough to reach this position where you have this sort of good model where it it is pretty comparable and comparatively good as compared to this model, right? Then you have a really good model and system for prop firms, and your chances of blowing your account with 0.5% per trade are next to zero with this sort of model, right? Or if you have a model that have similar quantities or metrics to it. This only stays true if you are consistently and perfectly executing your system and model as per the criteria and parameters that you've set. Just like I said before, you can change the metrics and parameters and can play with it, right? And of course, you can see that this is an intraday model. You can have the same metrics for a swing model or a scalping model too. Now, moving on to the next slide, let's discuss a risk model with risk per trade parameters for prop firms account with an aggressive style. Now, here by aggressive style, I don't mean that you're going to be blowing and passing challenges with just 1 to 2 trades. It's fully different from that, right? We're traders here, right? We're not gamblers. We know that in prop firm accounts, we first of all have to go through phase one, the challenge phase, and the verification phase, which is phase two, right? Before we get access to live capital. That is pretty common knowledge, right? Now, for the majority of prop firms, they've set the maximum drawdown at 10% for both the verification phase, challenges phase, as well as the funded stage, right? The maximum drawdown stays static at around 10%, right? Now, with this sort of model, you're going to be risking 1% per trade both in verification and challenge phase, and then at funded stage, you will lower your risk to 0.5% because at funded stage, you'd want to decrease your risk of ruin even more because who wants to lose capital, right? No one. Now these parameters only stays true if you have a system and model that lies in the profitable section of the RR and win rate table and the curve that I showed you earlier, right? And then your equity curve is towards the upside, meaning it's making progress and it's making profits in the long run. Also, another important thing is that this works in the ideal scenario when you are consistently following your system and not making any inconsistencies or having any irregularities within your execution of that particular model. And if you divert from your plane and start making irrational and impulsive decisions based on emotions and sentiments, then of course it's pretty self-evident and obvious, right, that these parameters won't work and you'll end up blowing your account. The system is fully perfect, remember that. It's up to you to be the deciding factor behind whether you are profitable or not. If you're not consistent, then if you're consistent, then good, you'll be profitable. But if you're not consistent, then that's up to you, and you are your own hurdle standing between you and your profits or progress, right? So make sure that you remember that at all times, right? You are the problem. You are the what am I saying? You are the reason behind your own problems, and you are the only one that can solve it, right? No one else can do that for you. Now, an important statistic here is that in phase 2 and phase 1, your risk of ruin is slightly higher, which is 7.8%, 7.84%, because you are risking 1% per trade. And remember, this risk of ruin is calculated based on the metrics of the models that I showed you earlier, which had 40% win rate and 3 risk to reward ratio, right? And based on that data, your risk of ruin is 7.84%, which means there is a 7.84% chance of you blowing your account even if you're following your plan perfectly without any mistake or inconsistency, right? That's the reality. But of course, if you divert away from your plan and stop respecting your system, this percentage value increases even more and your chances of risk of ruin increases. And then in fund stage, your risk of ruin is around 3.62% because you are risking 0.5%, and it means there is only a 3.62% chance of you blowing your account even if you're fully following your plan consistently with all those parameters and methods that I showed you earlier. And obviously, if you move away from your plan, this value increases one more. And now in funded stage, it will take you at least a losing streak of 20 trades for you to blow your account, which is extremely unlikely, right? And right here you can see that even with an aggressive model, you are protected and your capital is preserved because of how solid this risk management model is, right? So you don't have to worry about that. And right here, here's a different model here. This one is a more conservative model than the one I showed you earlier. Even for this risk model, the same model is used that I showed you earlier with the 40% win rate and 3 risk to reward ratio. But in this one, you'll be risking 0.5% in phase 1 and phase 2. And then during fund stage, you'll lower your risk to only 0.35%, right? And with this sort of model, your risk of ruin decreases even more and almost reaches next to zero, meaning your capital would be protected at all times and you'll never reach the maximum drawdown limits as long as you stick to your system consistently and don't make any irregularities or mistakes. And in fund stage, it would take you at least a losing streak of 30 trades for you to blow your account, which is highly unlikely and nearly impossible if you follow your plan thoroughly. Now, let's move on to the next slide. Now that we've discussed everything, let's wrap things up with some key takeaways. So, at the end of the day, risk management is the absolute foundation for long term success in trading, right? It doesn't matter how great your strategy is, if you don't manage your risk, it can fall apart, right? You've got to know your risk per trade and understand how that impacts your account in the long run. Every trade you take should fit within your overall risk tolerance, and it's crucial that your win rate and risk reward ratio are aligned with those limits, especially when it comes to your drawdown limits. One of the biggest things to keep in mind is the risk of ruin. Without proper risk management, right? Without proper risk management, even a system that's profitable can lead to wiping out your account, right? So it's not just about making money, it's about making sure you don't lose it all during your rough periods. And don't forget, adjust your risk management strategy depending upon the type of account you're trading. If you're working with a personal account, then you've got more flexibility in there, but you still need to prioritize capital preservation. On the other hand, if you're trading with a prop firm, the rules are a lot stricter, I don't know how it's pronounced, and you'll need to be more conservative to stay within their drawdown limits, right? So always be mindful of the risk, protect your capital, and stay disciplined, right? That's the key to staying in the game in the long term, for the long term. Thanks for watching.